I'm titled the talk today, Might We Now Head Back to an Honest Monetary System? And I wouldn't have thought that was possible until I'm starting to think it's more and more possible, because we have some very major changes that are taking place now globally, the way people think about things. The Fourth Turning is a book that I highly recommend if you haven't read it. It explains that every 4 generations or so, people start thinking about things differently. Their value systems change, and they start to, the worldviews change. And so the way they behave changes dramatically. This would be America's fourth turning that is taking place, I believe, started in the mid to late 2000s. And so they usually last about 1 generation, 20, 25 years. So a fourth turning lasts, four generations, or let's say, upwards to 100 years or something like that. Now, probably the most influential person in my life was Dr. Peyton Yoder, who was my history professor back in 1967, and he was convinced that there was a correlation between a country's monetary system, that is, if they debased their currency, that there would be a dramatic decline in their work ethic and also in their general moral behavior. And I just leave that thought with you as I go through the slides that I'm about to show you. This was really an important issue for me at that time, because when I was a young man, Vietnam was really in full-fledged. We started with a socialist program under President Johnson. The Great Society was a bump up in socialism in America. How were we going to pay for all of this? Charles de Gaulle was asking the same question in France, and he said, I don't like this. I'm going to ask for gold in exchange for the dollars that I have increasing numbers of. So he sent the dollars to the United States, and gold went to France and other countries as well. Very rapidly, America's gold hoard was starting to disappear. And so Nixon said, well, we can't let this happen. And so he closed the gold window on August 15th, 1971, and said, no more. We're going to default unilaterally on our obligation to give you an ounce of gold for every $35 you send. If you don't like it, too bad. So how did the dollar retain its value? How did the dollar retain its value when there was nothing behind it, when gold was removed from it? Well, Nixon sent Kissinger to the Middle East, to Saudi Arabia, and they worked out a deal in which the royal family would be protected by the United States military, but they had to require that OPEC demand payment for their oil in dollars, thereby putting a bid under the dollar globally. Because think of all the countries that are net importers of oil. They had to find dollars, so they had to go out and buy dollars. That created a strong dollar and allowed the United States to do what I think are a lot of very nefarious things in the years to come, things that I believe we're about to pay for. Defense spending, that was one of the big reasons. How are we going to pay for this war in Vietnam? Well, we printed money to pay for it. And once we went off the gold standard and had the petrodollar, then you can see that we went from $72 billion for military spending in 1971 to $735 billion by the end of last year. Now, there's a website that I would suggest you might want to look at in conjunction with what Professor Yoder said, his belief that things change when countries debase their currency, as the United States has, as all the Western countries have, and as nations throughout history have tended to do. WTF happened in 1971. You can go to the website. I'm going to show you a few slides that pertain to the economic impact, the social and economic impact that take place when countries start printing money. And so one of the things was right away we had a very egalitarian income distribution until 1971. After that, productivity continued to grow, but wages and compensation did not keep up. It went flat. Corporations started making huge amounts of money. Stocks really roared and did extremely well as well during the last number of decades. So we increased the money supply as measured by M2 from $685 billion in 1971 to $21.8 trillion. And what we see in the stock market then is just remarkable. This is a measure of $100 invested in the S&P in 1960 would have grown to 248 by 1971. But that 248 would have grown to $42,733 by the end of, well, by March of this year, actually. So we've had inflation, massive amounts of inflation in America, but it hasn't been consumer inflation until now. It's been inflation in the financial markets. And this has dramatic impact on the way people live their lives and the way they view society and on the political agenda as well. This slide is really out of date, but it shows the inflection point, 1971, when the impact on inflation. Now, we started having a tick up in inflation before that a little bit for Vietnam and for the expenses that the U.S. government was starting to go into debt and print money. But after 1971, with the petrodollar, it seemed almost unlimited. I'll run through some slides real quickly here that show how things changed income-wise after 1971. The incomes were really very egalitarian up until 1971. From that point on, the top 5% started growing. They become extremely wealthy. And then the middle class, the bottom 20%, and the middle and the median, the median incomes went flat as well. Wages to GDP dropped dramatically from 1971. The top 1%, the bottom 90% did extremely well after the Second World War. And there we had a middle class, a very thriving middle class in America. I grew up in Ohio, and my father was a machinist. All of the heavy equipment, the manufacturing stuff that was going on, people that had middle class earnings were doing extremely well at that time. Until 1971, that flattened out, and then the top 1% started just eating their lunch. I mean, the top 1% got extremely wealthy from 1971. Again, the growth in M2, and then we started running these huge budget deficits. The United States started running these huge chronic budget deficits. Very briefly, we ran a surplus during Bill Clinton's presidency, but since then, as you can see, and in 2008, it improved. But the point is that we have really abused. We've gone into debt. We're not paying our way. We're not taxing. We're living beyond our means and have been for a long time. The twin deficits, not only the federal deficit, but also the trade deficit. We've run a chronic trade deficit, and we had to do that as the world's reserve currency because we had to make sure there was enough liquidity, enough dollars sloshing around in the global economy to allow the dollar to become the world's reserve currency. That worked very well as long as foreigners, as long as net exporters were willing to take their dollars and buy U.S. treasuries. But now they've disappeared. I wonder why. They get 3% against a CPI that is 8% or higher. It doesn't make any sense to buy treasuries. So who's left to finance the U.S. deficits and the U.S. expenditures? Well, the Federal Reserve. We have to print money. That's the U.S. debt, the cumulative debt over 30 trillion. The big thing that happens when countries when they borrow so much money, when their debt to GDP starts to rise dramatically, something over 30% or so starts to become nefarious. That blue line there shows what the growth trend going back to something like 1870, I believe, and at 2.2%. It shows how we've fallen far behind, far below, 21.5% below our potential growth. As GDP has increased, our real growth has decreased very dramatically. So we all have been waiting for a long time for the Fed after 2008 to normalize its balance sheet. Well, I don't think it's going to happen. I really don't. And one of the reasons is because we can't have higher interest rates. The Fed has to really make sure that the U.S. Treasury retains its AAA credit rating. And it can't do that. If we start to have interest rates that go up higher than 4 or 4.5%, means that the interest on the budget is going to be equal to the amount we spend for defense and equal to the amount we spend for Social Security. So can you imagine, my first mortgage was a 17.5% mortgage. That was Paul Volcker was able to do that to curb stagflation in the 70s. It's a different story right now. And I don't know how anybody can really take the Fed seriously when they say they're going to normalize the balance sheet. Look at all the QEs that took place since 2008. They were going to normalize. You can see the path they were going to go on, and they had to give up. And then along comes COVID, and we're really in big trouble. But if that wasn't enough of a problem, we have the Ukraine. And that's a big problem for the Fed because it's not just the Ukraine, it's not just that Putin invaded the Ukraine, but it's the way we've handled it with our sanctions and shutting him off in the global monetary system. And so we're not, we had supply disruptions from COVID. We're having them in spades right now. David Stockman, who was in the Reagan administration, was on my radio show back on March 1st, and this was about the time that Putin was marching into Ukraine, and there was talk then about how are we going to deal with this. We're going to put sanctions. We're going to shut down the SWIFT system. We're going to not let Putin have his way, and we're going to really just destroy this guy. And David Stockman says, well, this is crazy as hell. If you're going to do this, it's going to hurt Americans as much as Russians. And you might say it probably hurts the Europeans even more than the Americans because of the gas, their need for natural gas. But look at the way natural gas prices have gone up in recent times. I think it's $9 now. And this is impacting inflation in a very major way. This is really making the Fed's job extremely difficult. It can't raise rates because of the reasons I just mentioned and a lot of other reasons I didn't mention. So Russia is not a poor country. I think the propaganda here has Russia as being, well, it is what it is, but it has natural resources. Platinum or palladium is very important, but lots of others too. And certainly food, grain, and especially with the Ukraine not producing and not being able to sell its grain, and all kinds of other things. But it's the disruptions of supplies around the world that is really causing so much trouble. And Putin, if he weren't aligned with China, I think you could say it's not much to worry about. But he is aligned with China, and China has built this new Silk Road, and they're continuing to build that new Silk Road. China, unlike the United States, which borrowed money to create a military industrial complex and go around the world and try to control the world through our military, China worked hard, produced things, sold them to the rest of the world, took the net gains they made by being a net exporter, built up trillions of dollars of foreign reserves, and now they have that wealth to go out and build up this new Silk Road and to make friends, in quotes, with nations around the world. This is a force to be reckoned with, I think, China and Russia together. Russia has the raw materials that this highly populated country that China needs. And Russia needs markets for that, and China. So it's a symbiotic relationship. Certainly, Chen Lin was talking to us at lunchtime a little bit about the history of the two countries. They're not natural friends, but the United States is driving. Definitely, our policies are definitely driving the two together in a way that I think is very dangerous. So when Putin went into to the Ukraine, the currency fell out of bed. The first thing he did was increase the interest rate from 9.5% to 20%. The currency, the ruble, found the bottom thereafter, very shortly thereafter. And then in March 25th of this year, he announced that he was pegging the ruble to gold at 5,000 rubles to a gram of gold. And then right after that, he said that nations that are unfriendly are going to have to pay us in rubles. Much as the United States built its reserve currency and strengthened its currency by making the world pay for their oil in dollars, Putin, in a small way, has seemingly done the same thing. And look at his currency; it's been the strongest currency in the world since then. Jamie Dimon just recently voiced some concerns. He said, "Brace yourself for an economic hurricane caused by the Fed and the Ukraine war." Well, I think some of the people at J.P. Morgan Chase tried to walk that back a bit because the markets got nervous when someone of this magnitude says something like that. But I think he has a reason to be concerned. If we look with the inflation rate where it is now, that the Fed has to try to fight, this is a chart from Incrementum that shows the PE ratio, the Shiller PE ratio relative to inflation rates. And right now, instead of being up there around 35, it might be a little lower than that because the market's been weak the last week, but it's still much, it should be down around 10 or 15 on the PE, probably. to be in line with the level of inflation that we have now. Of course, our interest rates are not anywhere close to the inflation rate, and that's probably why, so we're going to continue to have inflation. The Fed is behind the curve just as it was in the 1970s. I was a young man, I remember it very well. What does this mean for our investments then? What does all this mean? Well, that black line there shows you the market capitalization of the NASDAQ 100 relative to materials and to energy. And you can see the disparity and how much higher. This is the inflation in the financial markets that I was talking about. We've had enormous amounts of inflation. Only the people that are making all this money call it good inflation. But the people now, what's really causing trouble is now we have consumer inflation, which is causing a lot of turmoil politically and with the masses of people. The standard 60-40 rule that most investment advisors will tell you is 60% in equities, 40% in bonds. It's not doing very well this year. In fact, bonds are down, the US Treasury is down 30% or so. I don't know where the S&P, if it's down 20%, it was. It's probably down, I didn't check it the last day or two. There's nothing that's making money in the financial. The only thing that's done well is oil and energy so far this year. But gold has held its own. It's basically break even. It's not lost money. And I have to think that these big fund managers, when they look around and they try to, you take CalPERS or Illinois pension funds or some of these gigantic institutions, what are they going to do? Where are they going to go? If they continue to lose money like this, where can they go? And historically, when we've had these, that's what this slide is showing, when we've had these times when that 60-40 standard recommendation allocation doesn't work, gold has done extremely well. And best of all in my youth was the 1970s when that happened. Stagflation, I think you can pretty well say that that's what we have now. I think we have stagflation. How can you say otherwise now? Whether it lasts, how long it lasts, I don't know. Gold has done very well. The green is the Barron's Gold Mining Index. On the left there, the incrementum folks put together this data showing how gold mining stocks have fared during these periods generally. And then on the right, you see how gold mining, the green, did during the 70s. Silver really outpaced everything in the 70s, and gold did better than the gold mining shares. But I would suggest in part that was because gold was fixed at $35, $37, $38 actually before the lid blew off. And so there was a lot to catch up to in the United States in the 70s when the restrictions were removed from gold. Recently on my radio show, I had Doug Nolan on there. He is a portfolio manager for a company that, it's actually the McIlvaney funds, and he runs a bear fund for them. And Doug really expressed concerns about the need for the massive amounts of stimulus that's going to be required this time. And he cited the problems in structural finance and the derivatives. And he just thinks that the chances of hyperinflation are very real this time. Are they going to be able to get a handle on this thing? So I titled this slide, or something worse, like a crack-up boom. Now, a crack-up boom is an Austrian school idea. The Austrian School of Economics would have us have gold as money or silver as money, a metal as money, because it doesn't allow politicians to distribute money. It's really a system of meritocracy. If you have honest money, it's a market-driven economy, and people rise to the top based on not who they know, but what they know and how they produce. And that's the Austrian School of Economics. The Keynesians was more of a socialist school and that's what we've all bought into. The Western world has bought into that. I want to just read this. I'm going to just read it here because I think this is very important, and you can think about it and see if you think it applies to our current situation. This is the definition of a crack-up boom. A crack-up boom is an economic crisis that involves a recession in the real economy and a collapse of the monetary system due to continual credit expansion and resulting in unsustainable rapid price increases. That's the definition by the Austrians. The crack-up boom is characterized by two key features: excessively expansionary monetary policy that, in addition to the normal consequences, leads to out-of-control inflation expectations, and secondly, a resulting bout of hyperinflation which ends in the abandonment of the currency by market participants and a simultaneous recession or depression. I hope and pray that's not where we're at, but frankly, when I look at it, try to look at it objectively, that's where I fear we're at. And if we are there, or if we're something less like the current status of a stagflation, then this is really the only place to go. History shows this is where you have to go. When the currency self-destructs, you have to go back to some sort of confidence builder. You have to go back to a money that people will trust. And the Russians and the Chinese have been building their gold reserves dramatically, while the West has been telling us gold is still preaching Keynes's idea that it's a barbaric relic. Well, of course they're preaching that, because as long as you can print the money and you have control of the money, you can reallocate the wealth. So the people in power don't want to change. It's very natural. It's very normal. But what's going to happen, we don't know. The fourth turning, I believe, is upon us. And how this is going to go, only God knows. But it is, I think we're in very serious times. And what we can do, for sure, is be wise about the markets. The financial markets are vastly overpriced by any metric you care to use. And gold has always been the place to go. So I'd say stay out of debt, and commodities I think can do well, relatively well too. They've had their run more than gold has so far, but those pension fund guys are going to have to be starting to look at companies like Newmont and others that are making good money. Calibre, that's up here on the stage, making good money, a company with great growth prospects. So I think those are the areas that we need to look at going forward. Thank you very much for your attention.